The world of finance is changing fast. Cryptocurrencies are leading this change. Bitcoin, Ethereum, and many others are now common words. Many people are excited by these digital assets. They see new chances to grow their money. This new market is open to everyone all day, every day. It never sleeps, unlike old stock markets. This means opportunities can appear at any moment, but it also means risks are always present. Understanding this new frontier is key for anyone looking to trade. It is a world full of potential. This excitement brings many new traders. They come from all backgrounds. Some are tech experts, others are just curious about this new money. The crypto market offers a unique blend of technology and finance. Prices can go up very quickly. This can bring big profits, but prices can also fall just as fast. This volatility is a double-edged sword. It creates chances but also dangers. New traders must learn to navigate these wild swings. Without good tools, it can feel like sailing in a storm without a compass. In this dynamic environment, traders need reliable tools. They need strategies to manage their investments. So, what exactly is a take-profit order? Think of it as a preset instruction. You tell your crypto exchange to sell your asset. This happens when the asset reaches a certain higher price. You decide this price in advance. It is your target profit level. Once the market price hits your target, the order executes automatically. This means your cryptocurrency is sold. The profit is then secured in your account. It's a simple concept but very powerful in practice. It helps you stick to your trading plan. The main importance of a take-profit order is to lock in gains. Crypto markets are famous for their quick changes. A coin's price can soar, creating a nice profit on paper. But if you don't sell, that profit can vanish just as quickly. A sudden market dip can wipe out your gains. A take-profit order acts like a safety net. It ensures that when your desired profit level is met, the trade closes. You walk away with the profit you aimed for. This prevents greed from making you hold on too long. Ultimately, take-profit orders promote disciplined trading. Let's look at how these orders function in the crypto market. When you decide to buy a cryptocurrency, you often have a price target in mind. This is the price at which you believe it's a good time to sell and take your profit. With a take-profit order, you don't have to watch the market constantly. You simply set this target price when you place your buy order, or shortly after. The exchange's system then monitors the market for you. It's like having an assistant who never sleeps. Here is a simple example. Imagine you buy Bitcoin at $60,000 per coin. You believe its price will rise. Your analysis suggests that $65,000 is a good price to sell. So you set a take-profit order at $65,000. If the price of Bitcoin climbs and reaches $65,000, your order automatically triggers. The exchange sells your Bitcoin at that price. You have successfully secured a profit of $5,000 per coin, minus any trading fees. You didn't need to be online when it happened. The system handled it. This automation is a key feature, making trading more efficient. Section 4, the bright side. Advantages of using take-profit orders. One of the biggest advantages of using take-profit orders is securing profits automatically. As we've seen, the crypto market is highly volatile. Prices can change direction in minutes. Without a take-profit order, you might miss the perfect moment to sell. You could be asleep, busy, or simply not watching the charts. A take-profit order ensures that if your target is hit, your profit is locked in. This systematic approach to profit-taking is invaluable. It helps you consistently build your trading account over time. Another key benefit is the reduction of emotional trading. Greed is a powerful emotion in trading. When a coin is rising, it's tempting to hold on for more gains. This can lead to round-tripping, watching profits appear and then disappear. A take-profit order set during a calm analysis helps counter this. It enforces discipline. You make a plan, and the order executes that plan. This removes the stress of making in-the-moment decisions when emotions are high. Section 5. Navigating the pitfalls, common mistakes, and how to dodge them. A common mistake is setting your take-profit target too close to your entry price. While it might seem safe to aim for small, quick profits, this can be counterproductive. If your target is too conservative, you might get taken out of a trade too early. The price might continue to rise significantly after your order executes. You would miss out on larger potential gains. To avoid this, base your targets on careful analysis. Consider market volatility and the typical price movements of the specific crypto asset. Don't just pick a random small percentage. Conversely, setting your take-profit target too far away is another frequent error. Some traders become overly optimistic. They set unrealistically high profit targets. If the target is too ambitious, the price may never reach it. The market might reverse before your order can trigger. This can lead to a winning trade turning into a losing one. To avoid this, set achievable targets. Section 6. Smart trading. Implementing take-profit strategies wisely. To truly master take-profit orders, combine them with thorough research and analysis. Don't set your profit targets randomly. Use technical analysis tools like support and resistance levels. Consider Fibonacci retracements or extensions. Look at chart patterns. Fundamental analysis can also play a role. Understand the project behind the crypto. Strong fundamentals might justify holding for a higher target. A well-researched target has a higher chance of being hit. It also gives you more confidence in your trading plan. It's highly recommended to use take-profit orders in conjunction with stop-loss orders. A stop-loss order is the opposite of a take-profit. It sells your asset if the price falls to a certain level, limiting your potential loss. Using both creates a defined risk-reward scenario for every trade. You know your maximum potential loss and your target profit. This combination is a hallmark of disciplined trading. It protects your capital on the downside while aiming for gains on the upside.